Every exchange, every regulator, and every market maker on the planet uses one model to understand insider trading. It's been the gold standard for 40 years. Researchers just proved it was missing the entire picture. In 1985, a finance professor named Albert Kyle published a paper in Econometrica that changed Wall Street forever. An insider knows what a stock is actually worth. A market maker sets prices. Noise traders create a fog of activity the insider hides behind. Kyle proved how the insider trades just aggressively enough to profit without revealing too much. The model introduced Kyle's lambda, a single number measuring how much prices move in response to order flow. It became the foundation of modern market microstructure. Every stock exchange, every SEC investigation, every pricing algorithm traces back to this paper. But Kyle's model had one limitation nobody solved for 4 decades. It only worked for one asset at a time. In February 2026, researchers Christian Keller and Michael Tseng generalized Kyle's framework to an infinite number of assets, simultaneously. Their model proves that when an insider has private information, it doesn't just affect one stock. It spills across every connected market, futures, options, correlated equities, the entire cross-section of tradable instruments. Kyle's lambda generalizes from one number to an infinite dimensional matrix. A trade in one market carries information that market makers in completely different markets should be adjusting for. The price impact of a single informed trade ripples everywhere. The elegant surprise is that despite the infinite complexity, the equilibrium collapses to a single scalar fixed point. One number governs the entire system: the insider's optimal strategy, the cross-market price impact, and the informational efficiency of prices, all derived from one equation. There's a structure underneath the complexity, but you can only see it if you're watching everything at once. If your process watches one ticker at a time, you're playing a 40-year-old version of the game, while the informed money is exploiting relationships across the entire market simultaneously. Single asset analysis is a blind spot that's been hiding in plain sight for 4 decades. The math now proves what systematic investors have always suspected. The signal is in the cross-section, not in the individual stock. That's why you build decision infrastructure that watches everything at once. A system that detects how information moves between markets, across asset classes, and through regimes. The edge isn't in one trade, it's in the relationship between all of them. The game is infinite dimensional. Your process should be too.